Good morning and happy Good Friday for anyone that watches this video when it first comes out. So, first things first, this is the first video on this particular channel. I'm going to start getting into different subjects, maybe geopolitics next. But this is not financial advice. Number one, this is not personalized financial advice. I am not a financial advisor, but these are my conviction. These are my strongly held views and perspectives on investing after 6 years of experience, me personally. So, this video is not going to get you rich. I'm not telling you the best stocks to buy. But what I am going to tell you is there's certain things you need to do in any situation to keep your emotions in check, to keep your mental state in check. And this is how you get rich. This is not necessarily going to make you $1 million, but this will help you. And in some ways, this is important from losing a lot of your big chunk of your portfolio, because that's the number one key. Every day you don't lose money, you effectively make money if you have good investments, interest on your cash, and so on and so forth. So the first rule that I'm not sure if anyone's ever mentioned it quite this way. You've heard some variation of this, but the most important thing you must always remember, and you have to be humble in the stock market. If you have not yet been humbled, then you need to be. This is what you need to drill into your mind to stay humble. You're not entitled to anything in the stock market. That could also be said for life. You're not entitled to anything unless you earn it. Or, as Tony Soprano would say in The Sopranos, you're entitled to shit. Okay, you're not entitled to a damn thing in the stock market. What this really means is that you've heard the expression, don't get FOMO, don't get the fear of missing out. Specifically, what this means when we're talking about stocks, this means do not chase after a stock that's up 100%, 500%, especially if we're talking about on the daily timeline. Do not do that, because the odds are against you. You've missed the boat. You need to build the base and never chase, as I like to say. If you miss your entry, if you had a conviction and you were too afraid for whatever reason, and you see it, you see the train leave the station without you. I'm not going to say under no circumstances, but 9 times out of 10, do not chase after the train. Do not try to catch the rocket ship when it's going up. All things that go up eventually come down. So it's better to bet on the downside than it is on the upside, but that is also extremely risky. The best thing to do, sit on your hands and look elsewhere for a better opportunity, or wait for a good dip buy opportunity at the very least. But you're not entitled to anything in the stock market. This goes double for if you're a long-term investor. If you're up 100% in your stock, you need to take profits. You need to consider taking profits and compounding the interest, because your assumption is, well, you think the next thing it's going to go to 200% and more, and this does happen from time to time. If there's not a fundamental breakdown, then you might stay in it and sit back and kick your feet up, but you're not entitled for it to go on an endless rally. I bought a number of great companies in 2025 just recently on the dip. I bought Oracle. I bought SoftBank, which I was up 300% on. I was recently up 300% on Micron Technology. I was in before the rally even began. And there are other various stocks. I've seen the same thing. When you're up 300%, you need to take profit. Okay, especially if you were in the rally from the very beginning, you need to take profit, because the next thing that happens is, well, you're up 300%. Now you're down 100%. Or you're down 33%. Now you have 200%. You've lost 100% of your gains, not in total, but you've lost that final 100%. That final exponential multiplier is gone now. You're down one because you got greedy and you thought it would go on forever. When the fundamentals start to break down, that's when you need to take all your profit at once. And if you get a dip buy and the company is still good, then you can compound the money, and that's how you get wealthy. But you're not entitled to anything, so you always have to take the profits when the profits are there, and you have to leave, everything else on the table. You don't try and be the last person to take the last. Don't stick your hand in the cookie jar when the cookies are starting to dwindle. You're going to be exit liquidity. Someone else is going to come along and They're going to try to sell you those shares or those options when you're already at the top. They want to use you as exit liquidity. You don't buy tops. You always wait for a good entry. If you miss the entry, then you wait. Because if it's not an A plus setup where the risk is very low and it's very asymmetric, then there's no point in taking the trade. Then you're gambling. The one edge that you have as an investor or a trader that you don't get at the casino or sports betting or anything like that is that you have risk management. When you place a bet in the prediction market or sports betting or the casino, once you've placed the bet, all bets are off, as they say. And in the stock market, you can risk manage. You can determine how much money you put in. You can generally determine when you take it out. And the kind of strategies you want to do. You can hedge your bets, which is also very risky because you could lose both ways. But risk management is the key, and it's the one thing that prevents you from turning into gambling. But if you don't master the psychology of you're not entitled to anything, do not get the fear of missing out. You have to earn everything in the stock market, and the only thing that you might be entitled to if you're a long-term investor in a good company, you might be able to get dividends, you might be able to get some kind of interest payments. But depending on the entity that you're invested in, they might pass, the pass-through entities, they might pass some of their profits on to you. But unless you're invested in a good company that pays you some kind of dividend, you're not entitled to anything. Everything else is off. They call it realized gains and unrealized gains for a reason. One of the worst things you can do other than losing money is letting a green trade turn red. So you cannot get greedy, and you cannot. Number one, the best way of articulating it, you're not entitled to anything in the stock market. You might have been a good trader yesterday, but you have to earn it every single day. And you cannot think to yourself, well, I called the stock to go on a run, but you didn't enter the stock. Well, you're not entitled to anything. You can't chase after it. After it's left without you, you should have been in first if you saw what was coming. If you had conviction about what was coming, because nobody knows for sure, but you can do analysis, you can do your own research, and you always have to do these things. You always have to use your intuition, and if you don't have any intuition, then you should probably stay out of the market on a particular case. Another thing that I want to talk about, and this is just my opinion, I think a lot of people, they spend way too much money. There are definitely some useful tools if you're a day trader, but today we have a lot of free information. Again, you can just use your intuition on a lot of these things. Yes, there are people that pay for scanners. There are people that pay for discords. Even there are people that pay for advanced charting websites, which I think are completely useless. I don't think you should have to spend extra money on some platform that lets you, see different color candlesticks or something like that. You don't need a whole lot of indicators. You don't need to pay a subscription for someone's charting service. If you're using a good broker like Robinhood or Webull, and there are other brokers you can use, but they have built-in software that's very good, very free to use, and they have all the standard indicators that you need to use. Technical analysis is important, but there's some people that treat it like it's astrology, and it's really concerning because technical fundamental analysis beats technical analysis almost every day. Long-term metrics especially. Earnings matter, okay? If you're investing in companies that look promising, at least in terms of their sector that they're in, but they don't produce any revenue, they're going to eventually come crashing down. If you weren't in the stock on the rally up, then you need to get out and stay out. Fundamentals do matter. It sometimes takes Wall Street and hedge funds some time to notice that the fundamentals have changed for the better or for the worse, but long-term fundamentals are good. And in the short term, yes, you can use technical analysis to be very helpful, but it doesn't prove everything. I would say volume matters a ton. The RSI matters a ton. The moving averages, yes, they matter. They show you where the volume is aligned where the buyers and where the sellers are aligned, of course. But you can't use that as a predictive indicator for everything, especially not day trading, because one tweet, we live in the era where one tweet or a geopolitical movement can change everything, okay? And you might say that's a black swan event, but really, at the edge that you have is all about entries and exits. And if you cannot get a good entry and a good exit, and if you don't understand the risk management, then no amount of software that you're paying for is going to help you. That $100 subscription you're paying for this other platform is not helping you in the slightest if you don't understand trading psychology. And that if you're not first, you're last. Okay, if you're not one of the first people in, then you're going to be the exit liquidity. So if you cannot master entries and exits and sitting on your hands, then none of these extra programs or subscriptions mean anything if you don't understand trading psychology. That's why trading psychology is so crucial. It's everything. This technical analysis stuff is just to get you to buy a subscription and to keep you losing. Okay, you need to first master psychology, and that means buy low and sell high. If you cannot buy low or buy on the dip, then you don't buy at all. And then that literally can save you tons of money in every which way. You don't even need to know why a stock is going up. You just need to know that if you see volume and you can get a low entry, you obviously need to have some, or should have some kind of idea, but in reality, in day trading, a lot of people don't know even what the stock is about. But the most important thing is that you get a good entry and you prepare for an early exit if you need to. You have to have risk management, or else none of these other things matter. And a final thing I want to talk about is, of course, you should not just be blindly following what other people do. Not me, not anybody else. And especially not the hedge funds and the private equity funds. You don't trust other people with your money. It's your money. You've worked hard for it. You've earned it. There's no excuse for anybody in this day and age with all the information that's available, with commissions-free stock trading and all of that. There's no excuse to not have a self-directed account, or at the very least, if you're trusting someone else with your money and you're not staying up to date with what's going on, if you're only giving your money to a hedge fund and only once or twice a year checking in with them, or checking into the market every periodically, if you're not doing your own research and understanding where your money's going and what it's doing at all times, then you should not be investing. Obviously, people are going to keep doing this anyway. People are lazy. They don't want to learn finances. They don't really do a good job of teaching this in schools. And hedge funds love to take people's money just like the government and lose a lot of it, sometimes make a lot of it. And of course, they have certain responsibilities to their clients, but they don't always put the clients first. In other situations, they have to, and they miss out on opportunities. So you can definitely beat the hedge funds in a lot of cases. Maybe not in terms of dollar amount, but you can certainly outperform hedge funds percentage-wise just by using your own brain and taking emotion out of the equation. You don't have a responsibility for someone else's money, only your money. You should not be trusting other people with your money. Every decision that you make first is risk management. How can I not lose money today? And then second would be, how can I maximize the money that I can make? I believe everyone should have a self-directed account these days. Don't trust the financial gurus, especially the ones that don't show you anything. Number one is you have to master psychology. You have to master humility. You have to be patient. You can never get the fear of missing out. You can never revenge trade. You should never lose confidence either. When you're losing trades, you should always take the high probability trades no matter what. But of course, there's always this saying, take the money and run. When you've met your quota for the day, for the week, for the month, then you prioritize risk management. If that means not taking any more trades, every day that you don't lose money, you make money. As far as I'm concerned, your investments should be in such a way, your cash, the interest that you make on your cash, all of these things should be putting you in a better position to fight inflation. And holding on to your money for the right time is better than losing it, gambling without any strategy or any plan. build a base and never chase after stocks, and you're not entitled to anything in life or the stock market. You've got to earn everything. You've got to go after it. You've got to have conviction, and if you don't trade with conviction, if what you're doing isn't with conviction, then you might as well not do it. So the stock market's a very tricky game. It's designed to make people think they can get rich very quickly, which is not out of the realm of possibility, but to put yourself in that position, you need to have consistency and compounding. You need to compound your gains. You need to stay consistent if you want to survive. You have to do it for the love of the game. And with anything in life, you have to stay disciplined, and you're not entitled to anything. You've got to earn it. That is my big takeaway for lesson 1 of trading psychology. So this is for everybody. If you're new to investing, if you're just trying to get into it, if you haven't even looked at it before, if you've been doing it for years and you're still struggling, you've got to remember the fundamentals are patience and risk management and conviction. You're not entitled to anything. You've got to earn it yourself. So best of luck. There's a million opportunities in the stock market. You just got to look for them. And there's always an opportunity cost, but any money that you make is good money. Any money you can make with 2 presses of a button, buy and sell, that's good money. So just remember that you're not entitled to it. Just because you won yesterday, you got to work hard every day.